Hello, Accounting Superstars. This is Professor Don Bush from the Accounting Superstar channel. Glad you're here. Hey, we're studying managerial accounting, probably your second semester of accounting or maybe even cost accounting. And today we're studying variable costing. And I've done a few videos about absorption costing, and they went pretty well. And if you'd like to see them, they're on my webpage, accountingsuperstars.com. You can find all the videos listed there by topic. So today's lesson is about variable costing, but what we need to do is I need to show you the reason why we need variable costing, why people even do it. So we'll go through a quick example of what the problem is, and I'll show you the income statements through that we would have through absorption costing, and then we'll very quickly do an income statement for variable costing. So anyways, I hope this lesson doesn't go too long. I'll try to go as quickly as I can. But I'm glad you're here, and let's get rolling. So here we are. So here's a big question. Why do we appear more profitable when we are not selling more boats? So here we have a company, the Sunset Sailboat Company. They sold 40 Sunfishes in 2001, 40 Sunfishes in 2002. And so here's the sales data right here in this first chart. So the sales price per sailboat is $64,000. Now these are really nice sailboats. They're about 25 foot long and beautiful sailboats. So they cost quite a bit. So $64,000 brand new. And in 2001 they sold 40. And so we have sales at $2,560,000. Same thing happened, exactly the same thing in 2002, $2,560,000. So, okay, so sales are the same. Coming down to the next chart. Here's the manufacturing data right here in this blue box. Now, here's where the problem begins, is that in 2001 they manufactured 40 boats, and in 2002 they manufactured 60 boats. And you might say, well, what's the big deal? Why is that a problem? Well, the problem is that this fixed manufacturing cost in red here is going to be the problem. In fact, I've got a little newspaper here. It says bad news. So just to kind of recap so far real quickly. In both 2001 and 2002, they sold 40 boats. But in 2001 and 2002, they manufactured 40 boats and 60 boats. And here's the problem, is that some of this fixed manufacturing overhead is going to go into ending inventory instead of being expensed. And really, that's the whole problem right there. And what it does is it distorts the financial statements, because 2001, 2002, as far as revenue is concerned, are identical. But you'll see the expenses are very, very different. So here we go. So direct labor and direct material costs. So here we are. Here's variable manufacturing costs per sunfish. Direct materials. Here we go. So for each boat, it's $19,500, and if you do the math, 40 boats, $780,000, and 60 boats, you get $1,170,000. So these are the materials. This is the fiberglass, the teak wood, the rudders, the marine radios, the wiring, just all the direct materials. Direct labor, these are the people that actually build the boat, $24,000 per boat. And if you multiply it by 40, you get $960,000. If you multiply it by 60, you get $1,440,000. Now, coming down here, manufacturing overhead costs. Now, as you know, there's three different types of costs. There's direct labor, there's direct materials, and overhead. So now we're looking at the overhead. Now, some of this overhead is variable. Variable manufacturing overhead per sunfish is $1,000. So if you multiply it by 40 boats, you get $40,000. And if you multiply it by 60 boats, you get $60,000. And then finally, we come to the troublemaker, the problem right here, fixed manufacturing cost. I think they could rename managerial accounting to, here's a brand new name that I would suggest. How fixed manufacturing cost screws up your accounting. That's really the gist of managerial accounting. So fixed manufacturing cost for 40 boats is $400,000, and for 60 boats it's $400,000. That's because it's fixed. It does not vary according to the amount of boats built or sold. So coming down to the next chart here, folks. So here's some selling and administrative data. Now, some of the selling costs are fixed and some are variable. So here we go. Variable selling and administrative costs per sunfish, 1,750. Multiplied by 40, you get 70,000. Multiplied by 60, you get 105,000. And there are a lot of fixed selling and administrative expenses, and $30,000. Now, since they're fixed, it doesn't matter how many boats are built or sold. It's a fixed amount. So total selling and administrative expenses, 100,000 and 135. We're almost done through the data here, guys. We're hanging in there. Okay, here's the inventory data. Is beginning inventory for 2001 was 0. They manufactured 40 boats and they didn't have any ending inventory, and they sold 40 boats. All right. But in 2002, the beginning inventory was 0. They manufactured 60 boats and their ending inventory was 20 boats. So they sold 40 boats. So in other words, it's kind of like this. You start out the day with 0 apples. You buy 60 apples, and at the end of the day, you've got 20 apples left. How many apples did you sell? That's all there is to it. It's just that easy. Alrighty, so here we go. Here we come down to where we have to get to work here a little bit. So, all right, so I'm going to split the screen, and we'll grab the information. So here we are. How much did it cost to build each sunfish? So let's go up and grab the data. Let's go up and look. So here we go. All right. So direct materials for each sunfish comes right from there. And I'm going to highlight it just so it stands out, just so you know where I'm getting the information. 19,500. So let's put that into place. Direct labor, here's direct labor, 24,000. Put that into place. Variable overhead right here, $1,000. Let's put that into place. Okay, very good. So since this is variable costs, all we have to do is multiply it by the number of boats built. So 19,500 times 40 boats built is 780,000. 19,500 times 60 boats built, 1,170,000. Okay, coming down to the labor, 24,000 times 40 boats built, 960, and then $24,000 for each boat times 60 boats built. There we go. Variable overhead. Well, $1,000 times 40 boats built. That's tough to say fast. Okay, $1,000 times 60 boats built, 60,000. Okay, and then we come down to the fixed manufacturing overhead. So here we go. Total manufacturing cost. Here. Okay, fixed manufacturing overhead. So I guess we better fill those numbers in. All right, here we go. Fixed manufacturing cost, $400,000. There we go. And it's $400,000 for both years because it's fixed. It stays the same. That's why they call it fixed. Total manufacturing cost. So let's add it all up here. See what we got. 2,180,000. 3,070,000. Now, the reason why 2002 is more is because we built more boats. Number of sailboats manufactured. Here we go, 40. All right. And number of boats manufactured, 60. So the cost to manufacture each sailboat, here we go, 54,500 for 2001 and 51,167 for year 2. How do I get those numbers? Well, it's the total cost divided by the number of boats. So you can see that in 2002, it cost less to build these boats. And why is that? Well, it's because of the problem right here, this fixed manufacturing cost. That's the problem, guys, right there. Man, if it wasn't for that, managerial accounting would be really easy. There wouldn't be much to it. But that's the problem right there. That's why there's a difference, is that we're spreading this $400,000 over more boats. That's why each boat is less. All right. Which in a way is a good thing, it's a good thing. But it messes up our accounting. All right, so what is the cost of goods sold? All right, well, here we go. Well, the beginning inventory was 0. Let's go to this chart here to help us out. Right here. So beginning inventory was 0. Cost of sunfishes manufactured. Now I've got a note here. Cost to build each sailboat times the number manufactured. So let's see how much it costs to build each sailboat. Well, here we go. 54,500 times 40 boats. And we happen to get that same number right there too. All right. Okay, in 2002, the beginning inventory was 0. And cost of sunfishes manufactured, let's see if we get that 3 million. We do. 3,070,000 comes from right there. All right. So here, let me highlight that. There we are. All right, less ending inventory. Well, we didn't have any ending inventory in 2001. We can double check that right there. Ending inventory, 0, none. All right. So cost of goods sold. So here's how we get cost of goods sold, folks. Beginning inventory plus the cost of goods manufactured minus the ending inventory is the cost of goods sold. Let's finish out 2002. Well, beginning inventory was 0. The cost of boats manufactured was 3,070,000, but we did have an ending inventory of 20 boats. 20 boats. And how much did it cost to build one of those boats? 51,167. So 51,167 times 20 boats. There we go. 1,023,333. So once again, how are we getting this number? Well, in 2002, each boat cost 51,167 to build. And how many were in ending inventory? There were 20 of them. There we go. So 20 times that number, whatever it was. Alrighty. So let's get the cost of goods sold. So 0 beginning inventory plus goods manufactured minus the ending inventory is the cost of goods sold. And you can see the cost of goods sold is less. Look at that. It's less. And here's the weird part. Here's the weird part is that we sold the exact same number of boats. The revenue was the same. And so there's kind of a weird, well, I can't say we're matching expenses here very well. So this is called an accounting distortion. So these two numbers are different. And you think they ought to be the same. Kind of a weird situation here. All right, so we're going to make a traditional income statement. Here are the sales for 2001 at 2,560,000 right there. Let's drop it into place. Same thing in 2002. There's the sales for 2002. Drop it into place. There we go. Cost of goods sold. We figured that out just a moment ago. And it was kind of strange, weird. It ought to be the same because we're selling the same number of boats and all the costs are identical for each boat. But cost of goods sold is right here. I've already got it highlighted. So 2,180,000 and 2,046,667. Gross profit, all we have to do is subtract. Sales minus cost of goods sold is gross profit. There we are. And total selling and administrative expenses. Let's grab those numbers. So here we go. Inventory. There we are. So here's our selling and administrative expenses. We got 100,000 and it came from right there. Okay. And for 2002, it's 135, which is right there. There we are. Okay. And so our final net income, all we're going to do is take gross profit minus the selling and admin expenses, 280,000. And in the year 2, 378,000. Okay, here's why it's getting weird, is because these two numbers are very, very, very different. And I'm sure management is getting really excited, like, wow, we're doing so great. This is fabulous. And I bet the investors are thinking the same thing. I bet the bank is thinking the same thing. The employees, everybody's thinking, wow, we are doing so much better. But the reality is they're not. They still sold 40 boats for both years, right here. So here's the sales data. They sold 40 boats in 2001. They sold 40 boats in 2002. To me, that sounds like they're doing the same. Why the heck is their profit so much greater in 2002? It's because of those darn fixed costs. There's the problem right there. Fixed manufacturing costs, this $400,000, is that in 2002, some of this $400,000 was placed into ending inventory and was not expensed through cost of goods sold. That's the whole problem right there. All right, so this is just like a little proof here of why it's working this way. So fixed manufacturing cost, grand total, well, for both years, it's the same, 400,000, 400,000. Got that from right here. There we go. That doesn't show up very well, but okay. Number of boats manufactured, well, in the first year, 40, in the second year, 60. Fixed overhead per boat, all we have to do is a little division. 400,000 divided by 40 is 10 grand. That's fixed overhead per boat. And in 2002, it's only 6,667. So what we're doing is we're taking this fixed overhead and we're spreading it over more boats, which is a good thing. They're using their factory more efficiently. That's a good thing, but it's messing up the accounting system. It's making us look better than what we're really doing. Number of boats placed in ending inventory. 20 boats placed in ending inventory. The amount of fixed overhead placed in ending inventory. Well, if each boat is 6,667 and we put 20 boats into ending inventory, here's the amount of fixed costs that got placed into ending inventory. So in other words, out of this $400,000, 133,333 was not expensed and it was placed into ending inventory. So the difference in gross profit, here we go, 133,133. And so if we go to the income statement, the difference in gross profit is 133,333. So let's find it. There we go. All right, here's our gross profit right here. Gross profit, I'll highlight it in that yellow color here. In year one, it's 380,000. In year two, it's 513,000. So the difference is 133,333. All right. So, and all it is, that's the amount of fixed overhead that was not expensed. It was placed into ending inventory. You might say, well, so what? What's the big deal? Who cares? Well, the reason why we care is that we've got two income statements, year one and year two. And they should be totally, completely identical because they are doing identically each year. You know, they sold 40 boats, sold 40 boats. They should be identical. All the costs are the same, but it's that darn fixed income that's messing us up. And it's making the company look better than it really is doing, which is, it's really not a good thing because people make business decisions on this information. And here the information is not accurate. It's not really telling the truth. Weird thing though, this is called absorption costing, and I always have a hard time saying that, absorption costing. And that's because the fixed overhead is being absorbed into the products. That's where it gets its name. And it's GAAP. It's generally accepted accounting principles. We have to do it this way. We don't have a choice. So here's some questions for you, okay? Here you go. Did the company do better in 2002? Well, looks like they did. And even though I go through this explanation, a lot of students say, oh yeah, they're doing better. They're not doing better. They're not. If you think they're doing better, you miss the point here, okay? Go back to the start and watch this again, all right? They're not doing better. It looks like they're doing better, but they're not. And how they're really doing is what's important. All right, now, so second question, why does the company have a higher gross profit and net income in 2002? And it's because some of their fixed costs got placed into ending inventory and were not expensed, even though the company is performing identically each year. So do you think managers can and do use this to their advantage? Like some managers are wise to this. They know this. And a lot of other people don't know this. And so they know if they can produce more than they sell, their financial statements will look pretty good. Well, at least their income statement, they'll look more profitable than they really are, like in this situation here. And is it a good idea to have a large ending inventory? Is it a great idea to have a lot of stuff on hand and that isn't being sold? All right. Since it's on hand, they're not selling it. That's not good. And they have to pay for storage. They have to, these are expensive sailboats. They've got to have security. Oh man, there's damage. What if a big hailstorm comes through and just wrecks the decks of the boats, and the sunlight's going to deteriorate the boats? It's not good to have a lot of ending inventory. Bad idea. A lot of money's tied up too. A lot of money. The company still got to pay the bills for all the raw materials and the labor to build that ending inventory. So they may have a cash crunch, even though they look better on the income statement, but they're really not doing better. So, last question. How can we get rid of this accounting distortion and know the true earnings? Here's the answer, folks. It is called variable costing income statement. I have a superhero right here. All right. So, let's go through it. See how long it is here. Okay. Goes down there just a little bit. All right, so here's all what a variable costing income statement is we're going to expense all of the variable costs just like before, and we're going to expense them based on the number of boats sold just like before. And what we're going to do is we are going to expense all the fixed costs no matter what. We don't care if it goes into ending inventory or not, all right? If it's a fixed cost, it's getting expensed. We don't care. And that's all there is to it. All right, so let's go up to the sales data. Here we go. So we'll knock this statement out pretty fast here. So I like this variable costing a lot better, but it's not allowed according to GAAP. But it's still valuable because managers, smart companies, they'll do their internal financial statements this way so they really know what's going on. Now, if all goes well, both years should be identical because we sold the identical number of boats and the costs are identical too. So this way we can get a clear picture of what's going on. So the sales per Sunfish, the 25-foot sailboat. All right. And here are the sales for 2001, sales for 2002. And folks, I just got the numbers from right up there. Variable direct costs. Okay. The direct materials, direct labor, here we go. This is kind of a repeat of what we did before. And you know what? I'm going to, just to speed this up, I'm going to just put all three of these numbers right here. Where am I getting them? Right here. 19,500, 24,000, 1,000. There you go. It's the direct materials, direct labor, and the variable manufacturing overhead. So we're writing down all the variable costs here. And to get 2001 and 2002 numbers, I could just copy them from right up here, which is exactly what I did. Or you could multiply if you want to. If you like multiplication, you can go 19,500 times 40 boats sold, and you're going to get, there you go, 780. 19,500 times 40 boats sold, there you go. And 24,000 times 40, there you go. 24,000 times 40, there you go. See, all the numbers are identical. There you go, 40 and 40. All right, 1,000 times 40 is 40,000. So let's get a subtotal here, folks. All I'm going to do is get subtotal the variable costs here. Here we go. And so we're going to get a number. This is like a little subtotal. That's all it is. It's really easy. It's called the manufacturing margin, all right, which is a pretty cool number to know. So each sailboat sells for 64 grand, and the subtotal here of the manufacturing cost is 44,500. So let's do a little subtraction. There you go. So there's a margin, and that's a good thing. That means they're, it's costing them less to build these things than what they sell them for, which is kind of important. So 2,560,000 minus 1,780,000. There we go. And we should get the exact same number here too. All right. The variable selling and administrative costs. Let's find those. There we go. Variable selling and administrative expenses, 1,750. There we go. Times 40 boats. Remember, we sold 40 boats. And we sold 40 boats in the second year too. All right, so there you go. Contribution margin. Contribution margin is really easy. So all we're going to do is take our manufacturing margin minus our variable selling and admin costs, and we'll get our contribution margin. There we go. Very, very easy. So 780 minus 70 is 710. 780 minus 70 is 710. Now we come down to the fixed costs. And with the fixed costs, we are just going to expense these costs. We don't care if boats were placed into ending inventory. We don't care one bit. So the fixed manufacturing cost, let's grab those numbers. Here they are, the troublemakers. The troublemakers, fixed manufacturing cost, $400,000 for each year. And that's the way it should be because each year is identical. Fixed selling and administrative costs, let's grab those fixed costs. And once we have those, we'll have them all. Here they are right here, these $30,000 right there. So let's put that into place. There we go. And let's get a little subtotal here. 430,000, 430,000. There we go. And net income. So net income is going to be really easy. 710 is our contribution margin. I'll highlight it so it stands out. 710 minus our total fixed cost, the subtotal, will give us our net income, 280,000. And if we do the same thing for the next year, contribution margin minus this fixed cost subtotal, we get 280,000. There we go, folks. So guys, here's the moral of the story. If you're doing the exact same every year, you know, each year, exact same, sales are the same, costs are the same, your net income should be the same. And doing it the way that is required through GAAP, we don't get that. We get some wacky numbers where it looks like we're doing better and we're really not. It's called absorption costing is what it's called. And we come up with crazy numbers where it looks like we're doing better, but we're actually doing worse. And this only happens when you produce more than you sell. Because when you produce more than you sell, some of the costs are going into ending inventory. But if we use this variable costing, which I like better, we get the truth. Our net income is identical, which it should be because the 2 years are identical. I set up the problem that way so they'd be identical. Whew, okay, this video turned out to be kind of long. So hope it helped. Hit that like button and the subscribe button, and that way I'll know these videos help. And check out accountingsuperstars.com, and you can see all the videos listed by topic, and that way they're easier for you to find. So until next time, over and out.